Hello, you're going to make some trades in highschoolinvesting.com. I gave each of you $50,000, so let me kind of break this down and how you want to do this. What I'm looking for you to do is to think when you invest in stocks or a company, think of a dollar amount that you want to invest in. Don't get so caught up in what the share price is and the kind of the how do you execute the order. Just think about how much money you want to put first. So what I want you to do is I want you to take $10,000 and put $10,000 into five different companies. So you're going to have 10,001, 10,002, 10,003, 10,004, 10,005. And that's how I want you to think of it. So what you need to decide then is, well, what companies do I want to invest in? So what I want you to look at is if you go to the website finviz.com and you go there, you have basically the heat map of the entire, almost the entire S&P right here. Right now the market is closed. It doesn't open for a while. But if we click on this, you can see all the companies are listed by sector. So technology, you got Google, Facebook, Yahoo, all the different companies are kind of listed. You got business software services, telecom, you got services, Disney. And so someone asked, well, what is a ticker symbol? A ticker symbol is just kind of like an abbreviation of a company. It's kind of like the initials. So don't get too confused with that. So if you need to find out like a name of a company, you just type in the name. So let's say I want to buy McDonald's stock, but I don't know the ticker symbol. I just type in McDonald's, and you can kind of see where MCD. So McDonald's is MCD. If I do, let's say AT&T, and AT&T is T. If I want to know Disney, DISNEY is DIS. So just use FinViz to find the ticker symbol, and it'll pop up here right before, like Apple, AAPL. So there's where Apple would be. So you need to grab the ticker symbol first. Then the second thing is the dollar amount that you want to put in. So once you kind of know your ticker symbol, if you go to cnbc.com, let's say I want to buy Apple, was one of my five companies, AAPL. I need to get the share price. So right now the share price is $143.66. And so when I go to make a trade, so I need a couple things. I need the price per share. I need in the ticker symbol, and then once I get the price per share, I'm just going to take $10,000 and divide it by the price per share. So I'm going to go I want to put $10,000 into the company. I'm going to divide it by 143.66, and I'm going to get 69 shares. So my order to put $10,000 into Apple, I'm going to need to use 69 shares. So let me show you how you put the order in the system. So you go back to High School Investing. And you got to make sure you're in Consumer 2017, so make sure you're in the right spot. Then you go make a trade. So once you go to make a trade, you hit buy, you type this symbol in, AAPL. And Apple, we just calculated 10,000 divided by the share price, came out to roughly 69 shares. And you can see it's at 9,000. My order would be 9,000. So that's good. We just don't want to be over 10 because remember, you have 50,000. So if you put more than 10 in on each of your trades, you're going to spend all the money that you have. So we're going to be slightly under 10, so that's fine. Now, order type, there's different order types. If you want to look at the website, it explains all the different types of order types. A market order is going to give you the ask. So whatever someone's willing to sell it for, that's what you're going to get. If you want to specify your price, you would use a limit order, and then you put the price that you're willing to pay for it. So maybe you don't want to pay $143.54 and you want to pay $140 for it. So you put $140 in, and then you would go good till cancel. And then once I send that order in, it will execute the order once the price reaches $140. So if you're looking to get it at a certain price, you'd use limit order. But I just want you guys to have the experience of making trades, so we're just going to use a market order. So buy Apple 69 market order, we're going to preview it. And then once you preview it, you just kind of check it one more time, and then you confirm it. It takes about 10 minutes then to show up in your open positions. So if once you make the trade and you go to my order history, it's going to appear there. So if I go here, let me just kind of put this order through, and I go now to my order history. It'll hold there, it'll say delayed. So in real life, a market order executes right away, but since this is a free system, the quotes are delayed somewhat. You're getting the market order at right now at this time, but it'll take about 10 minutes to pop in there. So now I could go on to my next trade then. Make a trade stock. I type in my next symbol, calculate the quantity, and that's how many shares. So when you think of stocks trade at a per share amount. So when you think of Apple, one share of Apple trades at $143.89 a share. Right now, you can see the market's been open for about 20 minutes. 2.5 million shares have already been traded so far today. So it's a pretty, obviously, Apple, certain companies are very, very kind of actively traded. And just think, Apple just has tons of outstanding shares. So if we go in here and we can kind of look, go Apple. I'm in E-Trade right here, and I go in there, there's 5.2 billion shares that are held by investors. So when you own one share, you own a very, very, very small percentage of the overall company because there's 5.2 billion shares. Now, Apple does pay a dividend, so they pay a 63-cent dividend per quarter. So for every share that you hold, every 3 months, you're going to receive 63 cents per share that you own. And that's the dividend. So the dividend yield, if you take the 63 cents and divide it by the share price, you get a dividend yield of 1.77%. When you annualize that dividend. So it's a decent dividend. You could look at companies that have higher dividends. It doesn't mean that a dividend's good or bad. It just means that the company like AT&T, they've grown so much. They're pretty consistent on the revenues. They have a high yield, so they pay out 5.27%. So this is a better yielding stock if you're looking for dividends. But if you're looking for growth, you want to look at your companies that are growing. If you look at Facebook, they pay no dividend whatsoever because they're too busy taking their earnings and reinvesting in the company and retaining the earnings versus paying it out to all the shareholders. So if you take the price of the stock and relate it to how much the company makes per share, so this is the net income divided by outstanding shares. So if you take how much money Facebook makes and you divide it by 2.4 billion, it comes out to they make $4 for every share of stock for 12 months. So when you take the earnings, the 4, and you divide it by the 150, that's how you get a price per earnings ratio. So these are just basic metrics. What I want you to do though is I think as a young person, we shouldn't probably pick individual stocks because it's very hard to pick individual stocks. And if the company fails, you lose all your money and then you don't want to invest anymore. So I think as a young investor, there's a new product. They're called ETFs. They're exchange traded funds, and they kind of match the overall market. So if we go to U.S. markets here, you have the Dow, the NASDAQ, and the S&P. The Dow is your 30 large blue cap stocks. So there's 9,000 publicly traded companies roughly. And so the Dow index is just focused on 30 really, really large companies. So Disney, Microsoft, Apple, you could kind of look up and see what 30 companies make it up. NASDAQ, it's an index that measures how technology companies are doing. So Apple's a big weight, Facebook, Oracle, Amazon, all the big tech companies are in the NASDAQ index. And really the most broad index is the S&P 500. So the S&P 500 is 500 largely publicly traded U.S. companies. And so really when I think of the stock market, I think of the S&P because it's kind of comprehensive of the overall market. So what you do when you invest in mutual funds, you're giving your money to a professional manager. They're charging anywhere from 1% to 2% roughly to manage your money. And their goal is to try to beat these markets. So they, on a calendar basis, roughly, they only beat the market 30% of the time. So 30% of the fund managers are able to beat these indexes, and then the other 70% lose. So what's a really popular trend right now in investing is instead of putting your money into mutual funds, so let's say you only have like $500 to invest, you can't buy a lot of companies with $500. And by the time you buy a few shares of this company, a few shares of that company, you're paying anywhere from $5 to $10 for the trade and $5 to $10 to sell. So it doesn't really make sense to buy like 2 shares of this company, 1 share of this company. So people give their money to fund managers, and so the fund managers pools all these small investors, pools their money together, and then manages that money, that big pot of money for them, and charges a fee. So what investors are starting to do is, instead of doing that, they're putting their monies in what are called exchange traded funds that kind of mirror these indexes. And there's hundreds and hundreds, if not thousands, of exchange traded funds to choose from. But my advice to you guys, put your first chunk of money as you become an investor, just put it in the S&P 500. You're going to own 500 companies. If one company fails, you'll be fine. Some of the popular ones are the one that's traded heavily is SPY. So you can see 6.3 million shares. SPY is basically the S&P 500. And if we look at the snapshot of it, hold on, I want to show you the portfolio. The portfolio, the companies that make up, and it kind of shows you here. So 18% of every dollar that you put in, 18 cents, almost 19 cents, goes into these companies. Apple, Microsoft, Amazon, Facebook, Johnson & Johnson, ExxonMobil, Bank, this is Warren Buffett's company, and then these are Google, these two here. So that's the percentage of holdings. But you can see it's going to mirror basically the S&P 500. So something like this is what you probably want to invest in with your first huge chunk of money as you slowly invest into the market. You dollar cost averaging, you put $300, $400, $500 in a month once you become a professional, and you'll own the overall market. A popular one that does it automatically for you is Vanguard S&P. It's called VOO. And so it's kind of, if we look, it's the same thing. You can see the same companies listed there. But the nice thing about this one is the fees are really, really low. They charge very, very low fees on this particular fund here. So let me see here if I got the. You'd have to pull up the prospectus to see the fees, but the fees are very, very low on this particular one. It's one of the lowest ones out there. All right, so hopefully you know how to make a trade, buy your 5 individual companies, and when you pick your individual companies, try to pick a company from this sector, a company from this sector, a company from this sector, a company from this sector. Don't pick like 5 all in the same one, because if a sector goes down, you're going to have a huge loss on your portfolio. So it's good to diversify out. Pick a bank, pick a tech company, pick a basic materials company, pick a healthcare company. And then you'll see the leaders. The bigger the box means the bigger the company. So you could take a stab here and say, hey, that's in the, some of these are in the Dow because they're such a big box, because that's by market size. And when you see a small box, so when I go in here and I see a little small one right here, and I look, Versec Analytics, it's smaller in relationship to the other companies that are in there. Okay, so good luck, and email me if you have any questions.